The war inside every portfolio. Every investor, whether beginner or billionaire, faces one question: do I follow the market's momentum or stick to the company's fundamentals? In this ultimate breakdown, we unpack the psychology, the strategies, and the performance history behind momentum investing and fundamental investing, two competing forces that shape the financial world. Subscribe now for deep-dive financial documentaries that give you real market edge. Sets the stage by presenting the classic dilemma every investor faces: follow momentum, chasing performance, or rely on fundamentals, trust intrinsic value. What is momentum investing? Definition: buying stocks that have recently performed well and selling those that have performed poorly, based on the idea that winners keep winning, at least in the short to medium term. Psychology of trend following and confirmation bias. Notable proponents: Richard Driehaus, AQR Capital. Mark Minervini focuses on buying winning stocks and selling losers. Rooted in the belief that trends persist, short-term success often continues. Relies on behavioral psychology like confirmation bias and crowd behavior. Highlights key figures: Richard Driehaus, AQR Capital, and Mark Minervini. What is fundamental investing? Analyzing a company's financial statements, earnings, valuation, and competitive position based on intrinsic value and long-term growth. Philosophy of Benjamin Graham, Warren Buffett, Peter Lynch. Focuses on metrics like PE, EPS, ROE, debt ratios, strategy, built around analyzing a company's financial health and estimating its fair value. Long-term focus, looking for undervalued companies with strong fundamentals. Champions: Benjamin Graham, value; Warren Buffett, moats; Peter Lynch, growth at a reasonable price. Uses financial metrics like PE ratios, earnings growth, and return on equity. A brief history of each strategy. Origins of fundamental investing. Graham and Dodd's work in the 1930s, momentum studied academically in the 1990s, Jagadish and Titman, 1993. Performance trends over decades and in different market cycles. Fundamentals date back to the 1930s, Graham and Dodd. Momentum gained traction after 1993 academic studies, Jagadish and Titman. Reviews historical outperformance and how both strategies evolved in different market conditions. Momentum strategy. Breakdown tools. Moving averages, RSI, MACD, relative strength rankings, portfolio rotation, sector trends, risk, sharp reversals, whipsaws, false breakouts, high turnover and short holding periods. Uses technical indicators like RSI, moving averages, and MACD. Emphasizes high turnover, short-term trades, and sector rotation. Risks include false breakouts and sharp reversals, often driven by quantitative models and trading signals. Fundamental strategy. Breakdown income statements, balance sheets, and cash flow analysis. Discounted cash flow, DCF. Valuation models. Risk. Value traps, macro shocks, slow market recognition, lower turnover, long-term holding periods. Want to sharpen your investment thinking? Subscribe and join the thousands mastering the markets. Deep dives into financial analysis, from balance sheets to cash flow. Methods include discounted cash flow, DCF, and peer-based valuation. Lower turnover and longer holding periods. Common risks: value traps, delayed market reaction, and macroeconomic shocks. Key performance studies and statistics: S&P momentum versus value indices over 10, 20, 30 years. Quant funds blending both strategies, e.g., Renaissance, AQR, sector-specific performance, tech, consumer goods, energy. Academic meta-analyses and factor persistence compares long-term returns of momentum indices versus value indices. Reviews quantitative fund performance that blends both strategies, e.g., AQR, Renaissance Technologies. Looks at how different sectors respond better to one approach or the other. Draws from decades of academic research and historical backtesting. How momentum and fundamentals can work together. Quality plus momentum screens. Fundamental filters with technical confirmation. Factor investing and smart beta ETFs that combine them. Strategies that blend both. Use fundamentals to filter quality companies, then apply momentum screens. Or use momentum for entry-exit timing with fundamentally strong stocks. Introduction to factor investing and smart beta ETFs. Behavioral finance. Perspective. Why do momentum strategies persist despite being known? Investor psychology. Overreaction, underreaction, herd behavior. Value investing biases. Anchoring, loss aversion. Why do momentum and fundamental strategies persist? Explores human biases. Overreaction, herd behavior. Momentum, anchoring, loss aversion, value traps. Shows that market inefficiencies are often psychological, not logical. When momentum fails, when fundamentals fail, momentum crashes. 2009, early 2020 reversal fundamentals blind spots. 2008 crisis. Value traps in secular declines. Case studies of famous fund managers in both camps. Momentum crashes. Sudden reversals in 2009 and 2020. Fundamentals fail when macro conditions destroy intrinsic assumptions, e.g., 2008 case studies of famous fund failures and recoveries in both camps. Case studies. Real-world investors. Jim Simons versus Warren Buffett. Peter Lynch's blend of fundamentals and growth. Momentum hedge fund performance. 2 Sigma AQR. Long-term value picks. Microsoft, Apple, Costco. Subscribe for more real investor case studies and market psychology breakdowns. Compares styles. Jim Simons, quantitative momentum versus Warren Buffett, value fundamentals. Peter Lynch's hybrid strategy reviews key stock picks like Microsoft, Apple, and Costco as long-term winners. Analyzes hedge fund performance using each approach. Technical analysis versus fundamental analysis. How momentum uses chart patterns, volume, trend lines. How fundamentals focus on business model and economics. Pros and cons of each approach in different markets. Momentum traders use charts, price action, and trends. Fundamental investors rely on company performance and financial reports. Shows pros and cons of each, and when one outperforms the other. Strategy selection. Which is right for you? Risk tolerance and time horizon portfolio goals. Capital gains versus income. Behavioral fit. Discipline, research preference, volatility. Stomach helps viewers choose based on risk tolerance, time horizon, preference for research or trend following. Emotional discipline and reaction to volatility empowers retail investors to align strategy with personal behavior. The future of investing AI and machine learning in stock selection. Rise of data-driven investment platforms, ETF growth, and factor-based smart indexing. Potential convergence of strategies as tools evolve. Subscribe now to stay ahead in the new era of intelligent investing. Momentum versus fundamentals. 2 roads to market mastery. Rise of AI and machine learning in identifying patterns. Increased reliance on data-driven platforms and robo-advisors. Smart beta ETFs blending factors like momentum, value, and quality. Outlook. Boundaries between strategies may blur with tech.